In Sri Lanka, more women go to university, but fewer women join the workforce. Financial freedom is the key to empowerment.
ශ්‍රී ලංකාවේ කාන්තාවන්ගේ මූල්‍ය සාක්ෂරතාවය සහ රැකියා නියුක්ති ප්‍රතිශතය සාපේක්ෂව අඩුයි.
இது மாற்றத்திற்கான நேரம். It's time for change. As we celebrate International Women
A very good evening to all of you, ladies and gentlemen. We warm welcome you to First Capital Colombo Investor Symposium 2025, Invest with Impact. A day to remember, celebrate, network, and have a wonderful time. Today is about more than just strategies and numbers. It's about equipping you with the knowledge and insights to make decisions that not only yield returns but also create a meaningful difference, a huge impact to the world. In a world where the economic landscape evolves faster than ever, staying ahead requires insights that are not only actionable but transformative. So why are we here today? We're here to empower you, to help you see beyond the data, connect the dots, make informed decisions that drive both financial returns and meaningful outcomes. Whether you're a seasoned investor or exploring new opportunities, this symposium is designed to sharpen your vision for the future. Using the QR codes, you can surely connect and get all the details about the symposium and the key takeaways of the keynote speaker and also the panel discussion to the presentation as well. I believe each and every one of you and all of us, we want to be successful. We want to be happy in life and we want to do great things in life. And I believe that if you truly want to be successful and happy in life, we can surely be happy and successful when we know and when we do something to create a huge impact to this world. And we need to be the inspiration that we want to see in this world. And we need to be the change that we want to see in this world as well. Investment in more than the pursuit of profit. It is the power to shape futures, transform communities, and leave a lasting legacy. And true wisdom is in investing lies not just in seizing opportunities, but creating a ripple positive change that outlives all of us. And let's invest with purpose, vision, and impact. With that, ladies and gentlemen, with over 40 years of expertise, First Capital Holdings PLC is a publicly listed full-service investment institution in Sri Lanka, offering a wide range of capital market solutions, from primary dealing and corporate finance advisory to wealth management and stockbroking. Subsidiary First Capital Treasuries PLC, First Capital Asset Management Limited, First Capital Markets Limited, and First Capital Equities Private Limited, First Capital Trustee Services Private Limited, and First Capital Advisory Services Private Limited enable us to deliver tailored financial solutions that help clients achieve their financial aspirations. Backed by the strength of the Janashakti Group and guided by dedicated teams, First Capital combines robust fundamentals with resilience to navigate market cycles with confidence, empowering investments at every step. And now, ladies and gentlemen, to officially welcome you, we would like to invite, it is my pleasure to introduce Dilshan Veersekara, Managing Director, CEO of First Capital Holdings PLC. With over 25 years of experience in financial services, Mr. Veersekara brings a wealth of experience across banking, treasury and investment management, capital market strategy, and corporate finance advisory. Since joining First Capital in 2013, he has steered the company to new heights, establishing it as a leading full-service investment institution in Sri Lanka. Under his leadership, First Capital now holds licenses as a primary dealer in government securities, a full trading member to the Colombo Stock Exchange. And as a unit trust management and wealth management provider licensed by the Securities and Exchange Commission, the company also leads in debt structuring, trading, corporate finance, advisory and research, offering insights into macro fundamentals, equity, and fixed income markets. Mr. Veersekara has played a pivotal role in pioneering key debt structuring deals with international renowned development financial institutions and forging strategic partnerships with global institutions, focusing on emerging markets like Sri Lanka. Previously, he has served as General Manager of SoftLogic Capital PLC, overseeing investment and trading portfolios across subsidiaries, as Head of Treasury at National Trust Bank PLC. An alumnus of NCR Business School, France, and AOTS, Tokyo, Japan, Mr. Veersekara's academic achievements further complement his extensive professional success. Ladies and gentlemen, please join me in welcoming Dilshan Veersekara to deliver the welcome address.
Good evening, ladies and gentlemen. Our keynote speaker for today and chief guest, Honorable Minister of Labour and Deputy Minister of Economic Development, Professor Anil Jayantha. Our esteemed panelist for today, Mr. Gihan Kure from John Keels, Ms. Rachini Rajapaksa from Nations Trust Bank, Mr. Hasita Premaratna from Brandix, and our very own Dimantha, Head of Research. Distinguished invitees, ladies and gentlemen. A very warm welcome for you today, and we are very proud to present to you the 11th edition of our First Capital Colombo Investor Symposium. We've been doing this now for 11 years, and it's got bigger and better over the years, and it's essentially where we present our outlook for the country at the very beginning of the year. So you would see Dimantha and his team give you our macro outlook. So you would see numbers of GDP, tourist arrivals, earnings, fiscal side updates, fixed income calls with regard to interest rates and where we think they will move, as well as the equity market and the sectors that we are bullish on. Today, I believe we have people are still rolling in after office, but we'll have about, I think, 250 participants who are invitees at this forum. But we also have, I think, close to about 350 to 400 who are logging in online for this event. And the enthusiasm we witnessed has grown in leaps and bounds, and mainly because our research in the past has been fairly accurate. If you look at 2024, and 2023, the calls we made had an accuracy rate of over 90%, right? Some of the key calls we made, for example, like the domestic debt restructure, went favorably, that a lot of our clients who took our advice made a lot of money. We've also, if you look at 2024, forecasted growth and almost all the variables with a lot of accuracy. So I think that's the reason why this event has grown bigger, and I think you will find the report that we present very useful. First Capital also believes that our vision statement is improving the lives of all Sri Lankans through financial solutions. So we are probably the only investment bank that really makes our research available for the public free of charge, right? A lot of other institutions who engage in research offer it only to their clients, but we believe that sharing our research with the greater audience, with the greater public, will actually go to create wealth for all Sri Lankans. And I think that's why we sort of make this now a public event and not just keep it for a few esteemed clients or our clients only. So the research report was actually published yesterday. You'll find it in all social media and other domains, also on our website. The report is quite easy to read and is really backed by data and fundamental analysis. So it's not just hearsay, and you'll see that in the past, we've had a great sense of accuracy. So the format for tonight is going to first be the keynote address by the Honorable Minister. Thereafter, we will move quickly to Dimantha's presentation, where Dimantha and Ranjan from our research will present to you the key features of the report. The report also will be available online to be to download and read leisurely. And then we would actually have a panel discussion with Gihan, Hasita, Rachini, and Dimantha, where you can actually engage with the panel and ask questions, clarifications pertaining to the report. Not to forget, after that, we actually have a networking session with cocktails and dinner, so we really hope that you would stay on, enjoying the refreshments and making use of the chance to network and maybe even seek further clarifications from our team. If you don't already have a First Capital account, you should have one now. So that we have representatives here who would open such an account for you fairly fast. You can do that digitally, and we sincerely hope you'll make use of that. So with that, I will end and wishing you all a very fruitful evening. Thank you.
Thank you very much. Investing with impact is surely the key to success. And investment with impact is surely going to support to keep flying high and higher in life as well. And investment with impact will surely help you and motivate you to make a huge impact to yourself, your family, your company, the industry, and the world as well. So make sure that you invest with impact and believe in yourself and discover the potential within you and create a huge change to this world as well. With that, ladies and gentlemen, it's now time for the keynote address, one of the key moments of today's agenda. It's a pleasure to introduce Professor Anil Jayantha Fernando, the Minister of Labour and Deputy Minister of Economic Development. Professor Jayantha brings a wealth of experience and academic excellence to his role. He holds a Doctor of Business Administration and a Master of Business Administration in International Business from the Asian Institute of Technology, Thailand, as well as an MBA in Finance from the ESAP-EAP European Business School, Paris, France. Additionally, he has earned a postgraduate diploma in accounting and financial management from the University of Sri Jawadhanapura and graduated with first-class honors in commerce from the University of Kelaniya. A distinguished professional in the fields of finance, accounting, and management, Professor Jayantha is a fellow chartered accountant of the Institute of Chartered Accountants of Sri Lanka and a fellow member of the Institute of Certified Management Accountants of Sri Lanka as well. His diverse qualifications and deep expertise, combined with the commitment to economic development and labor welfare, make him an exemplary leader in shaping Sri Lanka's progress. Ladies and gentlemen, let's warmly welcome Professor Anil Jayantha to deliver the keynote address.
Thank you very much. Good evening to everyone. Ladies and gentlemen, and here there are lots of colleagues as well, and distinguished invitees, investors, and representatives of many organizations who are mainly in capital markets and investment platforms. In fact, so today's speech, my speech is not from academic perspective, so I'm playing a totally different role as a politician now. So in a way, I'm struggling how best I can mix my speeches, the academic plus the political. However, it's a fact that our government was given a different mandate. This mandate may have been perceived differently by different sectors of people in the country. However, from the government side and from my own perspective, how I perceive this particular mandate may make a kind of understanding or the help for you to understand the nature of that particular mandate. This mandate is connected to the nature of the government as well. It is nothing but a clear agency. We know that in any society, society means the collection of individuals at the end of the day. No matter how we have structured and organized our things in the society, at the end of the day, so individuals. So when individuals live in a society, we need so many things, so many arrangements. The government is also a kind of arrangement to take care of the common interest, public interest. By nature, or maybe by the learning or different economic systems, we may be motivated and inculcated and nurtured and trained to maximize our own utility as far as investments are also concerned. So investments, we invest with an expectation of the highest return subject to the different level of risks. But we are trained, we are nurtured to maximize our own interest. When our society comprises of large number of individuals, it is not possible, it is impossible for everyone to maximize their own or the individual interest. It is a myth. We will never, ever achieve that. So therefore, a government is a kind of instrument, the apparatus, to strike a balance between this individual interest and the public interest, so that agents are appointed. So we believe that in PP government, our government, take this mandate from that particular perspective to become true agents without having the conflict of interest. So therefore, our engagement, our policy decisions, and all the works are mainly to uphold the public interest over the private interest. Even people also may have different perceptions about our government. So rather than looking at from this particular broader perspective, they may have different perspectives. That could be one of the reasons why sometimes there is a little bit sentiment in the society that so new government is not doing anything, we are not seeing anything, so we are not getting any benefits. The price level is also the same as the previous level, or sometimes it's going up. So lots of issues are taken from the market and discussed. May be true, that could be so their issue at this particular point in time. Of course, we need to solve this, but being a responsible government, we need to look at from a very broader perspective. So where we considered one important thing, apart from our political ideologies or any other things, the number one was the stabilization. So I'm happy to announce that I don't say that it is fully stabilized, but we have been able to navigate this stabilization process with lots of difficulties and resistance to some extent to achieve certain part of stabilization. Number one is the political stabilization. You do not see any rifts among ministries, any rifts or contradictions among mainly the government, the MPs or our politicians. Sometimes maybe the media is highlighting some rifts between the political authority and the administration, the public servants. But the reality is not true. I mean, actually there is no such clash between public servants and the political authority, but it is a time, so it takes a little bit time for us to converge these things and develop or build a good understanding. That could be one of the reasons what we see. So I can say that this political stability has been achieved to a great extent. The other area is the fiscal stability. As far as the set criteria and some benchmarks, actually we have been managing it, but still there are some more areas to be addressed in order to have a very fair fiscal system, and by broadening the tax network and tax administration and all sort of things. However, as far as the revenue generation is concerned, so we have been achieving the targets fiscal stabilization. And the financial stabilization, just to great extent, so that is being done. So now we are experiencing a positive yield curve, normal yield curve situation. So, and the interest rate is gradually coming down. To some extent, we can say that that is being stabilized, and that is reflected in the forex market as well. And external sector also can be expressed in many terms. External trades and many yardstick can be taken, but mainly as far as the foreign reserves is concerned, I don't say that that has been stabilized, but signs are there that we can easily reach those targets, but challenges are there ahead of us in the next year. We have a very big target. As of now, that is somewhere. Again, we face a challenge by opening up, when we open the importation of motor vehicles. That's due to several reasons. One is just recommendations by IMF, and on the other hand, just when the economy is gradually reviving, we need to open up the operations there. So we need to allow everyone to access different, like the motor vehicles, to energize the economy. So there is a challenge, so we are handling this one. And as far as the social stabilization is concerned, it's a little bit challenging. We have to admit the fact that the large majority of Sri Lankan people are not living with an adequate the amount of income to have a decent life. They are really struggling, large majority. It is a fact. Because I know, not only within these, the Colombo and suburb areas, especially in the rural areas, actually they are struggling. Sometimes they are also confined to those things, so they are really embedded with the given condition. They may be happy with that, but that is not really up to the standard of having a good life. So we have taken measures to iron out these the situations to some extent, but that also has to be taken into account in the future with mainly a targeted social safety benefits or social spending, rather than offering the blanket spending. Now we are contemplating on to give more targeted benefits. And as far as the government, the composition is also concerned, many of representatives, agents of the people are not traditional or conservative politicians. Many have come from different backgrounds like me, academic, professionals, likewise. So therefore, from that particular label of inexperience or not been in politics as traditional politicians, yes, you may see, but we were in really the politics. We have that political experience, but however, yes, it is a fact that we are taking time. So we are really in a learning process, but that learning would really help us to drive the things in the right direction. Before coming to our policy direction, it is good to understand the structure of the economy, politics, and other aspects in the society as we understand. You also may have a different interpretation about it. When it comes to the politics in the past, basically this is the political sphere and economic sphere were really converged, was driven by one authority. So in the past, those who had the political power were the ones who really drive the economy. So gradually what happens, there was a detachment. Political economy, the political sphere was detached from the economic sphere. Then the economy was handled by a separate sphere. That was the story for a long period of time. But with the developments, especially the last couple of decades or maybe 3-4 decades, new sphere came into operation. That is what we call, everyone knows, this financial sphere. Financial sphere is really playing different roles. Of course, it deals with finance. To a great extent, finance can work as a supportive element to energize the economy, but on the other hand, finance also can act and operate as a separate commodity as well. When we take any other commodity like these equipments, chairs, or whatever, so physical equipment, assets, or intangible assets, so they come from the real economy. More or less the same elements, not the physical elements, but the aspects can be seen in the financial assets as well when it comes to shares, derivatives, and other forms of things in the financial markets. But there will be a rift or an issue when the financial sphere is not connected to the real economy, not driven by the fundamentals. There is a great opportunity for the financiers and the financial markets or the capital markets to play their own role by detaching from the real economy. I think we experience this kind of financial sphere in Sri Lankan economy as well. We need to bring about the robust and vibrant capital market in the future, but we have to understand the role of this financial market, because when we deal with alienated financial sphere, what happens, there is a limit. We can go up to a certain limit. After that, that would crash for sure. Why? The value characterized by these financial assets are no longer the intrinsic values. So somewhere down the line, lots of bubbles can be created. So many may earn lots in terms of investment. For example, the drivers such as information. So key things, especially in the financial market, is the information. The information asymmetry might create lots of distortion in the financial markets for sure. So how best we can create a symmetric information, how best the information is shared, and without leaving rooms for irregularities or insider trading or any other things, because you may claim that you have earned, your return has increased, maybe by accessing the information that the other people do not have. So that's not a really democratic one and would not last long. So therefore, our targets, our objectives should be to create the financial markets or the capital markets where information is freely available. Then what matters is your abilities and your talents, your competencies to continue with fundamental analysis and identifying investments and channel your investment in the right direction. So that would be the. Another sphere also has emerged now, that is none other than technosphere. So each of these spheres are trying hard to encroach into other territories and create or maintain their power. This is what we see in the present society, not only in Sri Lanka, in other countries as well. Political sphere has its own journey, economic sphere has its own journey, financial sphere has its own journey, and technosphere has its own journey. So it is a big challenging task. So our objective, our philosophy, our vision is to converge these spheres to a great extent as much as possible in order to create a real economy. So therefore, the financial market, capital market can link while just creating opportunities in the financial markets as a commodity, of course, just channeling the money, your finance into the real economy. So where the capital formation is going to play a very big role, and we have this particular understanding, and we would facilitate in whatever the forms that the government can support to create such a capital market, to create a good environment where capital formation would help energize the economy, where the savings, national savings, would be channeled to investments. And as far as our economic policy is concerned, as very clearly stated in our manifesto, since we do not have any conflict of interest, we do not have any ideas of doing businesses and investing and earning, that is the role, your task, we try to create a conducive environment for investment and democratic environment for investment. So whereby different areas are there, we mainly focus on the very strong regulatory frameworks and increase the efficiency in the market operations, and again facilitating with other areas as well, to mainly to deal with the facilitator role rather than taking any other aspects. In a good and efficient capital market, as I just earlier highlighted, apart from other aspects, it is indeed important to increase the market efficiency. Market efficiency can be compromised by the facts that I highlighted. We believe that the market efficiency at present is not up to the level. Even if you take the present extraordinary performance in the market, right? Of course, we would like to claim that that is mainly due to the visibility of the government policies. Yes, to a great extent, the investor confidence has increased, but I'm not going to be extreme that, so this is mainly and only due to the actions of the government or the visibility of the government. But we need to take into account how quickly the market reacted and performed like this. I think almost 50% gain within a short period of time. If it is a robust market or fundamental market, I don't think that the performance can go up quick. To some extent, you can argue that if the market was not performing very well and deprived, yes, there are possibilities that the hidden thing could have reflected in the prices, but it is up to researchers and analysts to research and study. Of course, we would like to say that as far as the government policies are concerned, yes, we encourage and take actions to promote the investor confidence, thereby increasing the market efficiency, of course. And the other area I would like to talk a little bit, I'm not going to talk much about the market or investment related things because you are the experts. 1 minute. Okay. The other thing, I have to explain a little bit about the economic condition or the situation that we are facing as of now. You also have your own explanation about the economy. When we took the power, actually we had a challenge. We faced a big challenge. Mainly, we wanted to decide either to scrap the existing IMF agreement and the debt restructuring process and think of a totally new one, because there are lots of issues associated with this thing, and that is one aspect. So we are the both pros and the cons were required to be taken into account. That was one approach. The other approach was to just to continue as it is until we stabilize the things. We took the second, the strategy, and when we work with that strategy, lots of constraints are there. And immediately after that, the IMF delayed its third review by a couple of months due to elections. Then revived immediately after when we formed the government, third review, and up to some extent, we were able to negotiate to bring about some social spending and social benefits and some tax cuts, and it was a really hard, the tough task for us to negotiate with them, because in a way they were ready to give us the passage or the space as long as we show them that how best we collect the public revenue. So that was the situation. However, we continued like this. And within that framework, we happened to come up with a vote on account that is within a very limited budget space to manage the day-to-day expenses, salaries, and the limited amount of capital expenses. However, immediately after the vote on account is active until the end of April, but again, we happen to take a decision either to wait until April to present the budget 2025 or to immediately present the budget 2025. So we took the second stance just to facilitate IMF discussion and stabilize the market, the macroeconomic variables in the country. So that time period, for us to come out with the budget really created lots of constraints. And in addition, system-embedded constraints are also there. The main constraint is the forecasted GDP for 2025. That has been calculated based on the given variables and the past trends, that is the expected growth for 2024, that is 2.1%. And the expected real GDP growth for another 4-5 years, that's also around 2 to 3%. Because of this low expectation or pessimistic approach, our GDP expectation for 2025 has been confined to 33,000 billion rupees, that is 33 trillion rupees. So other spending, mainly the primary spending, is subject to this particular cap. The 13% of GDP, expected GDP, is the cap for primary expenses. So no matter whether we have enough money now, we can't spend more than 4,290 billion rupees for 2025. So that is a big challenge for us, within which, again, there is a minimum, the ceiling, the floor for capital expenses, that is 4%, that comes around 1,320 billion, as I remember. So then we need to manage. We can increase that one, of course, but reducing revenue expenses. We can't reduce revenue expenses up to that much, because bulk of revenue expenses comprises of salaries, wages, pensions, other day-to-day operations. So very little space is there, but when it comes to capital expenses, some space is there, but some of these the spaces is again filled by ongoing the projects. And we were able to repurpose some of these ongoing projects. Now this year, in a way, we have a little space. However, we managed to incorporate the capital expenditure or the the items that we highlighted in our manifesto into this space. But anyway, I would like to mention that this is a challenging year, and the success, depending on the success that we are going to achieve in 2025, would really create a very comfortable position for us to continue with the next the review and the discussions in the future. So that's the present situation of the economy. Then how best we move forward with the investment and the capital markets? We need to take into account all the variables with your supports, your ideas, and to develop a vibrant capital market. Of course, we know that in the capital market, what's dominant and the scene and active is the equity market. So there is no active debt market. How best we can develop it? So how best we bring, subject to the previous constraint that I mentioned, how best we bring the other the instruments, derivatives and other things into the market where by reflecting the true values in the market. As long as transparency, accountability, governance, and the democracy can be established, and the information, symmetric information can be established, yes, of course, to a great extent, we can work towards developing such a vibrant market for sure. And so where it is imperative, there's the situation very quickly. Sri Lanka people are highly capable and competent enough to capture this technology and deal with technology. Technology could really create and help us to come out with new solutions, and not only in the capital market developments, but also in the other spheres of the politics and the economics and the financial sector and the techno sector as well. And by summing all those things, you can further create public discourses and dialogues about our policies, how best the government could cooperate with you. And I would like to summarize all those things, our perceptions, our orientations, our dedication, our facilitations, and our role as true agents of the public into a concept that we introduced called Clean Sri Lanka. Clean Sri Lanka is not something that deals with environment or creating an environment that is neat and tidy environment. It addresses, it goes into cleanliness in all the aspects: clean politics, clean administration, and the clean public service. It's on everything to serve or ensure a dignified life for everyone. As we have indicated in our manifesto, our long-term goal is to create an environment where everyone can live in harmony, peace, with a sufficient income, maybe the minimum income, to ensure they can have a life or acquire the basic things, the food, clothing, transportation, shelter, and all those things, because they are human needs. So therefore, human oriented approach is needed, and I can ensure and assure that our government would really commit on this, and there will not be any contradictions among the different members of our government, and we need the support. We are ready to work with all the partners, not only within the Sri Lankan context, maybe internationally, instead of promoting fierce competition, instead of promoting maximizing its own individual interest at the expense of public. Now, by taking into account the present global trends and the current developments, evolutions of the mankind, so we take the approach of collaboration, cooperation, and partnering, and to work with technology in the future to have a better society for human. Thank you very much.
Thank you very much, and please remain on stage. We would now like to invite Dilshan Veerasekara, Managing Director, CEO of First Capital Holdings PLC, to present a token of appreciation to Professor Dimantha Mathew, Minister of Labour and Deputy Minister of Economic Development. We would like to invite Professor Dimantha Mathew back on stage to accept the token of appreciation. We really appreciate your time and valuable insights as well. A very big thank you.
First Capital Research, we take immense pride in our unwavering commitment to providing high-quality, comprehensive research and analysis within the capital markets and macroeconomic domain. Our research philosophy is deeply rooted in our vision, driving us to consistently deliver insightful investment analysis through a rigorous fundamental valuation approach. Our research team serves a broad spectrum of unique needs, creating a diverse range of reports tailored to the specific requirements of our clients. Among these, our daily market updates have become an indispensable product, reflecting our dedication to delivering timely and valuable insights. Moreover, we recognize the importance of empowering the public with the knowledge necessary to make informed investment decisions. This is why we prioritize products like quarterly earnings analysis for listed companies, detailed corporate updates, equity strategy reports, in-depth fixed income analysis, and monetary policy outlook. While we remain committed to providing a steady stream of knowledge, we equally take pride in the accuracy and quality of our work. A prime example of this is our recent forecast of key economic indicators, where we successfully predicted critical variables vital for Sri Lanka's growth strategy, including tourist arrivals, tourist earnings, and worker remittances. We were also able to accurately predict the movement in interest rates, which was critical for investors to make strategic decisions in financial markets. This accuracy underscores our meticulous approach. But we don't stop there. We constantly strive to refine both the depth and precision of our analysis to better navigate the complexities of the financial and economic landscape. The consistency and accuracy of our reports set them apart, making them truly unique in the industry. Staying true to our vision of enhancing the lives of Sri Lankans through thoughtfully crafted financial solutions, we are proud to make all of our reports freely available to the public. Our efforts have not gone unnoticed, and we are honored to have been awarded the Silver Award for Best Stockbrokering Research at the CFA Society Capital Market Awards. At First Capital, our team is dedicated to delivering valuable insights and knowledge, empowering individuals and institutions to unlock the full potential of Sri Lanka's dynamic economy. Through our research and expertise, we are committed to creating opportunities, driving wealth, and contributing to a stronger, more prosperous Sri Lanka.
Invest with impact. Your today's decisions will surely decide your future, the future of your company, the future of this country and the world as well. So always believe in yourself and be the change that you always want to see in this world. Using the QR code, you can surely register yourself and you can surely access to the key takeaways of the keynote address and the key presentation as well as the panel discussion as well. Ladies and gentlemen, we are now ready for the key presentation of the symposium, Stability at Crossroads. Let me do the honors of introducing the two experts, Dimantha Mathew, Chief Research and Strategy Officer, First Capital, Dimantha Mathew brings over 15 years of experience in investment banking with extensive expertise in economic fixed income and equity research, as well as portfolio management, debt and equity financing, project finance, and corporate advisory services. Before joining First Capital, Dimantha served as the head of research as SoftLogic Stockbrokers and also held positions at Capital Alliance and John Keir Stockbrokers. He holds a Master of Business Administration from the University of Wales, UK, and a Bachelor of Law from the University of London. Dimantha is also an attorney at law in Sri Lanka and holds a prestigious ACMA and CGMA qualifications. And our next expert is Ranjan Ranatunga, Assistant Vice President, Research, First Capital. Ranjan Ranatunga has over 8 years of experience in both local and international equity markets. Before joining the Sri Lankan equity market, he worked as a senior analyst, serving buy-side and sell-side funds in the US and UK, bringing a global perspective to his expertise. Ranjan holds a bachelor degree from Stanford University, UK, and has earned ACMA and CGMA qualification. Ladies and gentlemen, this is a key presentation, Stability at Crossroads. Over to you, Dimantha Mathew and Ranjan Ranatunga.
Good evening, ladies and gentlemen. I will start off the presentation with a quote by Jawaharlal Nehru. Every little thing counts in a crisis. So Sri Lanka has gone through a period of volatility over the last 3 years. However, 2024 has been a year that we can be proud of. All the macroeconomic indicators have turned positive. And most importantly, the debt restructuring has been completed. With that, the all-important credit rating upgrade has been achieved. So with that, we've gone out of the default status. Now with that, have we achieved enough? That is the question that lies. We are going into 2025. Is it enough in terms of stability for us to go in a stable path? That's the question we are here to answer today. Let's move into the presentation. So this presentation will have 3 parts. First, to give you a bit of confidence, we will go through what we have forecasted during 2024 and how the markets have performed. And after that, we'll go into the key elements that are important for 2025, and finally, move into the recommendations. So first, looking at the track record. So these are the areas of accuracy that we focus on. So starting with accurate, mostly accurate, partly accurate, weak, and inaccurate. So looking at these 6 graphs, you can see that we've been broadly accurate on the tourist arrivals target, the earnings target, and the worker remittances. However, if you look at the credit growth aspect, the growth rates have been slightly above our expectations. And of course, the reserves target has been slightly below with the December payments going out. Of course, on the inflation side, that's where we've struggled to identify how the demand is impacting. So it's been well below our expectations throughout the year. So now let's look at the different investment products. On the bond side, we've been very accurate on where the yields will move. And in addition to that, something important is on the timelines. So first half, we expected yields to come down below 13.5 and then below 11.5 by the year end, which has been achieved. This is how the yield curve has moved over the last 12 months. Then On the policy rates, we've been less accurate here because there were a couple of rate cuts at the start of the year, though small, were beyond our expectations. However, the most important one at the end of the year, the big one, we were broadly accurate there, and also in line with our expectation, the central bank implemented the single monetary policy framework as well. On the banking rates, we've been broadly accurate there, and the rates have been broadly in line with our expectations towards the lower band in terms of WPLR. Exchange rate, this is something that has been difficult to predict because we were looking at a reversal and trying to find out where the demand in the system is likely to get created. However, things got delayed, so with that we saw with the peak season of exports coming in that the currency appreciated significantly, moving beyond our bottom bands as well. So on the equity market, we were broadly accurate there, where we've recommended to invest 100% funds that were allocated for equity to fully invest it. And also, we were expecting a bull run towards the second half of the year. So with the decline in rates, we were broadly accurate there. So now, let's go into the key elements of consideration. Here, something important to note for 2025 is that as I started off with the story, in terms of stability, have we achieved the level of stability that is required? Yes, we have achieved some level of stability, but can it be sustainable? A lot more needs to be done to achieve sustainability. So that's what we are looking at. So in terms of some key elements to look at is the deficit levels and also the SOE restructuring, which are key elements that are coming in the IMF agreement as well. So these are things that needs to be dealt with. And also, so we have a new government, and we are a couple of months into the government, so we are yet currently looking at whether this path will be followed. So that's the main reason why we say the stability is at crossroads, because implementing these will be key for sustainability. So we are looking at three elements: on the political side, on the economic side, and on the global side. So on the political side, with the new government, we've actually brought down our risk levels to low. Why did we do that? On one side, we have a new leader from the NPP party coming in, and then also something important is that the government has managed to achieve 2/3 majority, which means, what does that mean? On the political side, we have some level of stability, and when you have some level of political stability, it goes on to the fact that you have policy stability for a medium to long-term period of time, which is what is required for long-term investments. And with that, over the last couple of months, we've seen that there has been some level of consistency from the previous government to the new government. Policy consistency was there to build up confidence. So that's one of the main reasons why we've brought down our risk level to low risk. Next, we are going to look at on the economic side, economic indicators side, and the global side, how things are looking at performing. So to take you through these two elements, I would like to invite Ranjan to look at all the macro variables and also forecasts that we have. Over to you, Ranjan.
Thank you, Dimantha. Yes. So thank you, Dimantha. So as Dimantha explained before, First Capital Research had a very good year last year with almost all our forecasts coming true. And Now, next, let's look at what is in store for Sri Lanka for 2025. So before we go on to our forecast, let me start off with GDP. So in terms of GDP, we have, so for last year, we had a GDP growth of between 3 to 4%. But with the numbers coming in, the GDP growth has performed beyond expectations. And by the looks of it, GDP for the year can close in an average of around 5%. And now let's look at what things moved inflation above expectation. So in terms of GDP, first one is deflation. So we saw deflation coming in for the first time after so many years. And for the last 4 months, we have been having deflation. And for the month of December, we saw a slight bump, and CCPI was recorded at a deflation of 1.7%. Then we saw two of the biggest sectors, one, the construction, and the tourism, which goes hand in hand with the economy and almost employs about 40% of Sri Lanka's employment. So we saw a recovery in these two segments. And you may already know how tourism sector performed, with tourist arrivals coming in around 2.3 million. 2.1 million, while in terms of construction, with the recovery in the system coming through, as well as starting of the multilateral projects, we saw a recovery coming into construction as well. So these two indicators were one of the main factors that pushed GDP to perform beyond expectation. Now, so with that, with GDP performing above expectation, we revised our outlook to between 4 to 5% for 2024. And going forward, we expect GDP to perform between 3 to 4% for both 2025 and 2026 as well. And let us look at a few things that will be driving GDP forward in the coming year. The main reason that we're expecting to drive GDP forward is the consumer sentiment. So consumer sentiment has been on an overall uptrend in the past. And now, with the pay taxes being announced, cuts being announced, we believe consumer sentiment can rise further with the increase in disposable incomes. Also, together with this, we are seeing a lot of activity on the construction sector. We have seen new projects coming, and yesterday we heard a very good news with the President's visit to China, the signing of the new Sinopec refinery, totaling to about $3.7 billion. So such new investments are coming in, and it will uplift the lives of the people employed in the construction sector, which is one of the biggest sectors for Sri Lanka in terms of employment. So this upliftment is also expected to boost the disposable incomes of the people associated in that industry. Then again, we have inflation. Although we will be moving out from deflation level, still we will be below the 5% mark identified by the central bank. And for the first 3 quarters, for the first 9 months, we can safely assume that inflation will be below the 5% mark. However, with the base effect that was created with the deflation, we expect inflation to rise up and cross the 5% threshold. But however, this is not considered significant because the overall average will come between 3 to 4% for 2025. Then, of course, we have the electricity generation. Again, today we heard a very good news with electricity tariffs being reduced by 20%. So, contributed by the favorable weather, contributing to higher renewable energy generation, together with the stable oil prices that we are seeing in the global market, has contributed to a stable electricity prices. This is also expected to boost disposable incomes like what we have saw in the previous year. While the second factor that I want to speak about that will be boosting GDP growth is the business sentiment. So overall, on the business ground level, we have seen a significant recovery. And as you can see, the Purchasing Managers Index, which is a leading indicator to economic performance, have performed. And we have all 3 sectors, including manufacturing, services, and construction, on the expansionary method. So as you can see here, the line that is, the dotted line that is being highlighted in red is a neutral threshold, while performance anything above it shows an expansion, while performance below it shows a contraction. So since April of this year, we have seen PMI performing above the neutral zone, signaling an expansion in all 3 sectors of the economy. With the with the activity improving on the ground level, we saw that trickling down to the business confidence as well, with business confidence recording at 174 points, which is a high of 58 months. And to mind you that, for the last 10 years, the business confidence has been averaging at about 122. So this is a very significant improvement that we are seeing in terms of business confidence. So with the pickup in the business confidence, we also think that credit is going to be something significant that will be driving GDP forward. And as you can see here, this is central bank published data. We see both demand for loans as well as willingness to lend improving both from the consumer side as well as from the bank side, which will push up private sector credit in the coming months. So with that, we expect private sector credit growth to surpass the 12% mark for both 2025 and 2026. And just to give you a bit of an insight, we were expecting private sector credit growth to come around 7.5% for 2024. And by the looks of it, we still, it seems like it will outperform our expectation and close around the 8.8% mark for this year. We're not talking about the credit, we also have to talk about the state credit. So in terms of state credit, we have not seen state credit on expansionary method on the last few months, mainly due to the spending constraints that the government has. And going forward also, we don't expect state credit to play a major part in credit growth. Next up, we will look at the external position and how this will impact the reserves of the country. So, as I mentioned to you before, consumption is one of the key factors that we're expecting to drive growth in the current year. And also with consumption, what comes is imports. So given that Sri Lanka is normally an import-dependent country, we have always seen the gap between imports and exports. And we believe the gap will also continue in the future as well, where imports will surpass exports, mainly due to the fact that our GDP recovery is expected to be strong, and normally when the GDP rises, imports also rise along with it. Then the second factor is a vehicle import ban. So vehicle import ban is also expected to be lifted. The personal vehicle import ban is also expected to be lifted in the coming month. And this is expected to also have a toll on imports, with imports growing. And looking at the history, Sri Lanka has an average about $1.1 to $1.5 billion in terms of vehicle imports in the year of 2020 and in the past. So we can expect something similar or something slightly lesser, given that the disposable incomes have not recovered, to come in terms of vehicle imports as well, picking up imports in the coming year. So with imports widening, we expect trade deficit also to widen. As you can see here, trade deficit is slowly going to widen as the economy expands in 2025 and 2026. Although the trade deficit is widening, we have two critical factors for the economy, that is the tourism as well as remittances. In terms of tourism, we are, as you all are very bullish on tourism, we are also very bullish. We expect 2025 to be the best year for tourism, with 2.5 million arrivals. That is surpassing the 2.2 million arrivals that was recorded in 2018, which is considered the best year for Sri Lankan tourism sector. So for this year, we expect that to be broken, and this year to be the best year in terms of tourist arrivals for Sri Lanka is to be 2.5 million arrivals. Then following that, we are expecting arrivals to go up to 2.8 million by 2026. While the remittances has also been a steady performance for Sri Lanka during the past, with generating about $6 to $7 billion annually. So what we have seen in the past is that remittances is a stable growth factor with a growth of around 10% annually. And we expect that to continue in the forward years as well, with roughly about a 10% growth in CAGR during the next 3 years. Having told about the tourism and remittances, which is slightly going to offset the impact of the widening trade deficit, another factor that we had to look at is the repayments, because that is a critical factor that is going to affect the BOP position of Sri Lanka in the next year. Coming off from peaking at a surplus of 2.5 billion for 2023, BOP surplus is slowly coming down, mainly due to the fact that the imports are widening and the trade deficit is widening. And Sri Lanka is having given the high nature of imports that Sri Lanka is having, the impact that is coming from tourism and remittances is not enough to offset that impact. So with the repayments also coming in, we expect surplus to come down. But however, given that our country currency is now on a currency has been on a we have been maintaining a flexible currency regime, we may see that offsetting the impact enable us to record BOP surplus in the coming months, years as well. With the BOP surplus coming in, we are expecting reserve growth to be slow. And that is being given with the slowness that we are seeing in the BOP as well. So with the balance of payments growth coming down, we expect that to take an impact on the reserve position as well, with reserves growing to 7 billion from 6.1 billion in 2024. However, that will further pick up to 7.5 billion in 2026. So with that, let's look at the fiscal side. So as Dimantha mentioned, during a crisis, every small thing matters. And I think, in our opinion, the government fiscal side is that small thing that we are talking about now. Because I think the fiscal discipline is a crucial factor for the next stage of Sri Lanka's growth. So as mentioned, so when you're talking about the fiscal position, the first thing that we have to look at is the government revenue to GDP. So revenue to GDP for Sri Lanka, for revenue has been very strong in terms of for Sri Lanka this year. With the taxes going up and collection improving, we saw revenue picking up. And for the first 10 months, Sri Lanka has recorded a total revenue of 3.2 trillion, largely in line with the IMF estimates as well. And so with that, we are expecting revenue to GDP to close in around 13.5% for 2024 and go up to 14.7% in 2025, 15.5% in 2026. Few things are considered to bump up this revenue. So recently we heard the government is looking to bump up the withholding tax from 5 to 10%. So that is going to partly contribute towards the expansion in revenue. Then we have vehicle imports also coming in. As I mentioned to you, we have about $1 billion to $1.5 billion worth of imports every year. So with the government looking tax, so part of the vehicles newly coming in will be taxed at above 400%. So that is expected to bump up revenues as well. Then the part of the other revenue that is coming in is partly attributed to the GDP expansion, where with the overall GDP picking up, together with the digitization initiative that the government is taking, the wastage, the corruption, and the leakages in the revenue system are expected to come down. So all these factors are collectively contributing towards the revenue target that we mentioned before. With revenue targets, with revenue performing well in line with our expectations, we expect the primary surplus to also hover in the range of 2.5 to 3.3%, while the budget deficit is expected to gradually decline to 4.6% from 5.2% probably recorded in 2024. Then we have debt restructuring. So as everyone who are present here today know, Sri Lanka completed external debt restructuring in December. And along with that, our ISP debt or the commercial debt has also been restructured. So these, the new restructured deal includes 7 bonds, and this is a yield curve of that 7 bonds that was spoken about. Then something interesting I want to point out here is that this is a repayment schedule or the joint working framework. And if you notice here, up to 2027, we have very low maturities coming in. So these are expected to help Sri Lanka manage its cash flow and cash position. And in terms of maturities, we have bond maturities closing on 1.1 trillion. Expect to remain very low in 2025 as well, with first quarter, second quarter, and the fourth quarter recording one of the lowest maturities in terms of bond maturities, which will help help to maintain the low interest regime currently present in Sri Lanka. Then moving on to the global outlook. So now we have talked about a few things. First, we spoke about the GDP growth and what are the factors that will be driving GDP growth forward. Then we look at the fiscal position of the government, whether the government has capacities to do what is being needed or what are in store for Sri Lanka. Then we'll be looking at now the global arena. In terms of the global arena, the entire world underwent a challenging period in 2022 with inflation peaking in 2022, but has been gradually coming down with the crisis easing globally. And now I think it is safe to assume that global interest rates in the major economies are expected to stay below the 4% mark in the medium term. So with with inflation coming down, in order to boost growth globally, we saw monetary policy easing across most of the countries. And as you can see, from the second half onwards, majority of the countries went through monetary policy easing. And going forward, coming into 2025, we can expect similar policy easing to come in as the global economy looks to bump up its GDP and bump up its growth. Then, as I was mentioning, we have been having very slow growth in terms of global space. If you look at the chart here, you can see how the Europe and the US have been recording flat growths or very, very small growth levels. In terms of, then when you compare against the peers such as China and India, we see that they are performing well above the developed countries. And let's look at how this is going to impact Sri Lanka next. So as Dimantha explained before, with the completion of debt restructuring, Sri Lanka regained that lost credit rating, or the since we were classified default in 2022, we came out of that. And now we are being considered as CCC rating category by two major agencies. One is the Moody's and one is the Fitch. And we have the third agency, that is S&P Standard & Poor's, who's be waiting for confirmation on the $175 million bond, which is held by Sri Lankan Airlines for their rating upgrade to be reviewed. So once it be reviewed, we may see S&P also coming forward and lifting our country's rating as well, which is very positive for Sri Lanka. How this affects Sri Lanka? So what we have seen in the past is when developing countries mostly coming towards the monetary policy easing cycle, the returns that they are generating from the already invested assets will be coming down. That the rates are coming down globally. And with that, the funds they are in abroad will be starting looking at alternative opportunities, mostly in the emerging countries. So what we have highlighted here is how the emerging countries are posing a better growth opportunity compared to the developing countries. And we believe this is one of the main factors that the investors focus on in terms of diverting their investments to different asset classes. So with that, first thing, as I mentioned, the growth factor. The second thing is the valuations. The emerging markets also offer a cheaper inward opportunity for investors compared to developed markets in terms of valuations. So both these factors are considered positive factors for the fund shift to happen between the two regions. So we believe with this, Sri Lanka will also get an opportunity to see some of the added or some of the new funds moving to Sri Lanka for looking for investment opportunities. So that's why we believe 2025 year is going to be a good year for investments as well as for Sri Lanka in terms of foreign direct investments. So with that, for next stage, we have the recommendations. So in terms of recommendations, you all may already know that we cover both bond and equity recommendations. And to take you all through this, let me invite Dimantha, who will take you all through the recommendations.
Thanks, Ranjan. So as you heard, things are looking favorable on the global front as well. In 2025, the fund flow is likely to be shifting towards emerging and frontier markets. So let's look at the recommendations for 2025. So on the bond side, what do we expect? So encompassing all these elements, macroeconomic elements, we've created something called a fixed income health score. So those who have been with us over the last 4 or 5 years understand this. So as you can see, when the score moves down, the pressure for interest rate pressure for interest rates to move up increases, while the score moves up, the pressure for interest rates reduces. So you can see during the 22 period, there was a significant pressure on interest rates with the score really moving down. Now we are seeing a peak in terms of the score. So you can see that interest rates have sort of bottomed out at this moment of time. So we are seeing the best interest rates from the past over the last 12 to 18 months. So with this, what we are expecting from here on is as the economy gradually accelerates, as the business activity moves into the MSME segment, the lower segments, the acceleration to significantly improve. And with this, some amount of pressure to come into interest rates. So that's why we are expecting the health score to gradually move down. So, but something important to note is that even at the end of the year, still the risk level in terms of interest rate pressure seems to be very low. So first, let's look at the policy rates. So we've had a big rate cut coming in November, and with that, we think that is sufficient to sizably accelerate the economy. So with that, we feel that throughout 2025, policy rates are likely to be broadly stable, and the acceleration in the economy will happen. And with it, so with the acceleration coming in, we think that there could be some amount of pressure coming into interest rates as well. However, it's not going to be significant. So with that, we are looking at only about 100 or 150 basis point rise in rates throughout 2025 until the end of the year. So let's look at the banking rates. So with that, with the economy expanding and credit demand coming into the system, we feel that there could be some amount of pressure coming into AWPLR as well. However, something to note is that state credit is contracting because of the cash surpluses coming from the state-owned enterprises. So with that, we feel that the economy has a lot more room for credit to accelerate. That's why we've upgraded our credit figure. So with that, we feel still that AWPLR will only rise to a range of 10 to 12% for by the middle of the year, and towards the end of the year, 10.5 to 12.5%. Finally, let's look at the exchange rate. So exchange rate, it has been a bit tricky because we are looking at a sort of a reversal here. So consumer demand in the system matters for this. So we are now expecting a significant demand to come into the system, not only because of the low interest rate, but because of the additional stuff that is happening through the government as well. Electricity prices coming down, pay taxes coming down. So with all that, we feel that there will be a considerable rise in consumer demand. And with that, obviously, there is going to be import pressure also coming in, likely to lead to some amount of depreciation. 300 to 310 is what we target by the middle of the year, and 305 to 315 is the range we are looking at towards the end of the year. So around a 5% depreciation for the full year, and that is not a lot because it's broadly coming back to the 30-year average, which also has been around the 5% mark. Yeah. Finally, let's look at the equity market. Yeah. So here, something important to note that on the equity market, corporate earnings, we've actually upgraded our earnings target here. So we are looking at around 22% increase in corporate earnings compared to the 15% that we expected previously for 2025. And with that comes the upgrade of the ASPI target. So now we are looking at 17,000 for the ASPI. In terms of range, we are looking at 16,500 to 17,500. So with that, we believe that beyond that range, investors should be looking at booking profits and possibly increasing cash allocation. Yeah. So that's it in terms of our recommendations. So something important to note here is, again, I would like to remind you that every little thing matters in a crisis. So something important to note is to keep an eye on what the government is doing and what the reform agenda is happening. So the progress of the reforms will be significantly important for the trajectory of the economy. Thank you.
Thank you very much, Dimantha and Ranjan, for that key presentation. With that, ladies and gentlemen, we're ready to dive into the panel discussion. Let's take a few minutes till the stage is set for the panel discussion.
First Capital Asset Management boldly surpasses the incredible milestone of managing over 100 billion in assets. Our track record is an upsurge of consistent growth, prudent risk management, and client satisfaction. Trust isn't earned overnight. It's forged through results. Thank you for placing your trust in us. Invest with confidence. Invest with First Capital. First Capital proudly claims the pinnacle of success at Slim Brand Excellence 2024 Brand of the Year. This prestigious win reflects our commitment to empowering lives and building secure financial futures for all. First in excellence, first in trust. First Capital, the Brand of the Year for a reason.
Investment in education, investment in knowledge, and investment in experience pays the best interest. Ladies and gentlemen, it's now time for the panel discussion. And let me do the honors of introducing the moderator and the panelists. Moderator for the symposium, Deshani Ratnayaka, Vice President Corporate Finance, First Capital. Deshani Ratnayaka brings over 14 years of experience in banking and financial services. Beginning her career at Citibank, Colombo, she managed financial and non-banking institutions as Assistant Vice President for Financial Institutions Group. Her expertise spans capital markets, risk and credit management, and compliance. Deshani is a CFA charter holder and an associate member of the Chartered Institute of Management Accountants, UK. Ladies and gentlemen, Deshani Ratnayaka. Our panelists, Gihan Kure, Deputy Chairman, Group Finance Director, John Kears Holdings PLC. Gihan Kure oversees the group's finance, taxation, corporate finance, strategy, treasury, IT, and corporate communications functions at John Kears. A former chairman of Nations Trust Bank PLC, Gihan holds an MBA from the Jesse H. Jones Graduate School of Management, Rice University. He is also a fellow of the Chartered Institute of Management Accountants, UK, and serves as a committee member of the Ceylon Chamber of Commerce. Ladies and gentlemen, Gihan Kure. Hasita Prebaratna, Managing Director, Brandex Group. Hasita drives the overall strategy and transformation of Brandex, overseeing its global business. He has extensive experience in capital markets, economics, and strategic finance. Having served as Group Finance Director and Chief Strategy Officer, he is also an independent director at NDB Bank and has served as Chairman of the Audit Committee at John Kears Holdings PLC. A fellow member of CIMA, ACCA, and CMA, Hasita has won numerous accolades, including CIMA Star of the Year Award 2012 and the Most Outstanding Royalist of the Year 1997. Ladies and gentlemen, Hasita Prebaratna. Rajini Rajapaksha, Independent Non-Executive Director, Nation Trust Bank. With over 30 years of experience in fund management and finance, Rajini Rajapaksha is a fellow member of the Chartered Institute of Management Accountants and CFA charter holder. She has held leadership roles as CFO of IBM Sri Lanka and Bangladesh and senior fund manager at C-Bank Asset Management. A founding member and former president of CFA Society Sri Lanka, she has contributed extensively to the CFA community, both locally and globally. Ladies and gentlemen, Rajini Rajapaksha. And once again, we would like to invite our final panelists of this symposium, Dimantha Mathew, Chief Research and Strategy Officer, First Capital. And it's now time to dive into the panel discussion. Deshani, over to you.
Thank you. I hope you can all hear me clearly. So first of all, a very good evening to every one of you who's here once again. We truly value your presence this evening. On to the panelists, a big thank you for gracing us with your presence, and we look forward to a very fruitful discussion this evening. It is my privilege to share the stage with you, and just to remind you all that at the end of the session, there will be a chance for you all to pose in your questions to any of the panelists here this evening. To those joining us virtually, we welcome you as well. And you too will also have the opportunity to ask what's on your mind. Just post the questions on the Zoom chat. So just to kind of set the stage for what we are about to do this evening, we heard some very encouraging presentations and views on the state of the economy and outlook for 2025 from a macro sense. And what we are going to do this evening, in the next few minutes at least, is to sort of see how these trickle into the various sectors and what the thought leaders here with us this evening have to tell us about that. So Hasita, your expertise in the apparel and export sector is critical to us this evening. Gihan, consumer and leisure, have been navigating both challenges and opportunities, and so we want to hear from you on how the sector is evolving and innovating to meet the new challenges ahead. Rajini, in the banking and finance space, always, sector update is complete without that update. And so to hear your views on the broader space on that sense. Dimantha will close in on final sentiments with where we are going. And so just to start off the proceedings for this evening, Hasiti, if I may just sort of pick your brain. We've, as a nation, we have come out of various challenges, COVID-19 being one of them, and just general economic, pressures. And with that has generated so much of change in terms of how people spend, trends, work, so much, right? The list is endless. And so in terms of apparel and in terms of exports, with all of those, remote working, hybrid working, and people sort of moving in from official workwear to casual workwear, how do you see that shift, and how has that impacted the global apparel industry, specifically Sri Lanka? And what changes and adjustments do you think, as a sector, you all need to sort of work towards?
Yeah, thanks, Deshani. First of all, thank you for having me here, and good evening, everybody. So when you look at the apparel industry, if you look at like many other industries over the last few years, it has been a real roller coaster ride. First, we had the COVID pandemic basically zeroing our orders. Just when we woke up one day, we almost felt that the world has stopped, right? And then from there, we saw a very quick recovery, probably quicker than what it should have been. And that led to artificial demand being created in 2020 and 2021, which made all of us to fast-track our capacity expansions, all of that, and build capacities, suddenly, which in 2021 and 22 created a significant demand, much more than what ideally it should have been, in my view. But then 22, towards the end of 2022, things started to settle down. World started to open up, and people diverted their spending from buying apparel at home to maybe travel and other means, which led to a lot of a quick drop, a sudden drop in the demand, because actually there was a lot of shopping that happened online during 2020, 2021 when people were at home because there were subsidies, and that gave people the kind of, you didn't have anything to do, they just bought it and kept it in the wardrobe, and almost 12 months of inventory at home, right? Because you didn't have a place to wear it as well. And when things started to open up, suddenly people felt, now we don't have to spend money on buying apparel, let's spend it on other things. So it was a crash in demand. 22, 23, big hit to the whole supply chain globally. And I'm sure you're aware, a lot of paper articles, a lot of criticism, industries closing down, all kinds of things you heard. But that's the impact of that drop. But soon things have settled down. Probably it took about a year, year and a half to settle down. But through 2024, we have seen the demand coming back. That's the good news, right? But the demand has come up in different ways. Like you asked, the type of product categories have changed a lot, especially the demand for lingerie and related products have somewhat stabilized, while the active products, there is a big positive. Now, Sri Lanka is predominantly a lingerie destination, so we did have an impact last year due to that factor, and the price points also have quite tightened. But the bigger challenge I see is that, you see, retail will grow at about 2 to 4% globally, right? That's not a big growth. But this year we saw almost 20% type of growth in the industry from a low base, of course. But then having said that, it's also due to some of the other supply chain reorganization that's happening due to geopolitics and the situation in Bangladesh as well. So we saw quite a bit of orders moving in, but the challenge is really not the volume of orders now. We have the volumes, we have the orders, and if the prices are right, we can actually grow more. But the problem is, can we be profitably growing at those price points is the question mark. So that's one big area, because if we then transform our cost structures, improve on the productivity, and bring technology, digital into play, automation into play to bring that cost per unit down, there's plenty of orders to play with. That's number one. Number two is, I think specifically to your question, is the newness of the product. The innovation side is something that we have been working as an industry in Sri Lanka a lot. Globally, this has moved, but competition from other countries have caught up a lot, right? So now I think we have to fight for better product to be launched globally, which will give us an edge and a better price. And that's where that value addition will come, because at the end of the day, with our population, 22 million, and other industries growing, apparel generally will struggle at a point when other industries grow to find people to work, right? So in that context, it has to be a lot on productivity-related growth, a lot on more value addition, where we bring better product, better innovation, and ask for better prices from our brands. So those are the two broader dynamics that we are currently working on to see how the growth should be looked at from Sri Lanka's perspective from apparel exports. I think it's not only for apparel. This probably will apply for some of the other selected industries, export industries as well.
Thank you, Hasita. Online shopping is always a dangerous thing. Thankfully, with exchange rates going the other way, it was a deterrent to people like me. So, Gihan, just over to you. With the tourism sector showing promising trends, I mean, it's definitely encouraging to see the numbers that we just looked at. We can't also forget the fact that the industry is, there are shocks that can happen and we need to be prepared for. How do players such as JKH see the industry in the medium term, 2025 to medium term? And do things like international expansion, moving into other sectors, geographies, would those things also sort of come into the mix?
Yeah. Good evening, everyone, and thank you for having me on this panel. Yeah, in terms of tourism and potential, I think whilst we've seen a recovery and we've achieved just over 2 million for the last calendar year, I think as we've said consistently over the many years, I think Sri Lanka is yet to really fulfill its potential in terms of tourism. It's one of the lowest hanging fruit. It's one of the easiest ones to sort of move the needle, and it has a significant multiplier effect. So we all know that, but if you really look at it, I mean, I saw the target that was put out here, or estimate forecast for 2025 being 2.5 million. But I think the potential is even far, far greater than that. And there's not a whole lot we need to actually do to achieve this. I mean, it's a lot of things I'm sure all of you all have heard many times before, but as a country, we are still to launch a proper destination marketing campaign, which has been lacking for many years. It's 15 years plus since the end of the conflict, and we haven't really had one single destination marketing campaign to promote the country. We were just about to before the pandemic, but then, of course, that wasn't the timing. So I think that's an imperative. We really have to go out there and create a lot more awareness. As a country, we are fortunate that lots of travel sites, blogs, websites have ranked Sri Lanka as, you know, the top 10 destinations to be visited and so on. I think just today there was something I saw on BBC where we are the 9th destination in the world that's recommended. So we have a lot going for us, but I don't think we have helped our cause as much as we can in terms of having a sort of targeted destination marketing campaign in some of the key areas. I think closer to home and John Keel's itself, I think in terms of tourism and what we can do for the country, we launched now City of Dreams and Cinnamon Life just a couple of months ago. We're seeing good traction. It's early days, but the type of feedback we are getting once we've opened and once we have done a lot of pre-marketing and conferences and events, I think nothing like having a proof of the pudding in terms of being able to showcase the property itself. And we're having very positive feedback and reviews from, say, travel agents and particularly agents who represent MICE, that's conferences, incentive travel, and so on. So there's a little bit of time that one needs to sort of get traction on these things. But whilst we focus on tourism as a whole and look at all the diverse offerings that the country has, we also need to develop the city tourism aspect of the country. So if you look at other countries, like whether it's Thailand, whether it's Malaysia, Singapore, of course, is a city-based country. But if you look at all these other countries, the city tourism also plays a significant role in terms of bringing tourists into the country. So for us, when we looked at this and the vision of Cinnamon Life 10 years plus ago, that was part of it in terms of not just attracting people to come into the wonderful attractions that we have in the country. Yes, that's certainly there, but also having people have a reason to come and visit and stay in Colombo. And that's where you can also get scale. Whilst you have wonderful attractions like a Sigiriya or Ayala Park, there's only so many people that you can cater in one of these locations before it gets overcrowded. So you need to focus on all the diversity of the offerings we have and also focusing on Colombo. So I think those are some of the areas that we believe will be catalysts to really drive and create demand apart from the destination marketing and awareness creation that we spoke of. If I can just take maybe another minute.
Sure.
If you look at the way outbound travel out of China grew maybe 15 years ago and sort of exponentially grew over the last many years till the onset of the pandemic. India is where China was maybe 15 years ago in terms of tourism and outbound travel. And everyone talks of, tourism being sort of the decade of India being ahead of us. And Sri Lanka is so well capitalized to ride that opportunity. So if you look at outbound travel out of China, 100 million plus outbound travel, India is still lagging in that context. And with the sort of growth that India has seen, I think that is our biggest opportunity. So there are a couple of things that need to be worked on: improving connectivity, reducing the cost of connectivity into Sri Lanka. But these are largely still solvable issues that are within our control as a country. And if we do that, I think tourism can take off. To your last question about John Keys, I think, yes, we have diversified our portfolio by having some presence in the Maldives, but really our sort of larger plays in Sri Lanka. Yes, we are exposed to the vulnerabilities of Sri Lanka, but hopefully we are looking at a far more stable country and, like I said before, be able to ride that wave of the tourism growth.
Thank you, Gihan. Rachini, if I may just come to you. So we saw Dimantha and Ranjan shared with us trends on private sector growth and that it's supposed to pick up in the next year or so. How do you see this where non-performing loans and all of that are concerned? I mean, now the banks are showing slightly better recovery. I mean, there was a tough time in the last couple of years, but the last few quarters have shown better ratios. But how do you see the next year, the next 2 years for the banks? And what strategies do you think they should adopt to sort of manage the NPLs across the board?
So, thank you, Deshani. Good evening, everyone. I hope I'm audible. And so therefore, if you look at the banking sector, in 2022, we had a tough year post-COVID. Then 2023, it peaked and the impairments were very high. But in 2023, the impairments were at the peak. But in 2024, we saw the impairments tapering down. So in terms of the profit and loss accounts of the bank, you saw the impairment charges coming off in 2024. But if you take the balance sheet side, that's the impairment, the provision cover, that's the impairment reserve divided by the loan book, it has been increasing. So therefore, the balance sheet has strengthened over time. And so now the banks are in a better position to lend, but of course, they have been taking a cautious approach. And also, I think personally, the government securities had a higher interest rate compared to the AWPLR. And so the banks had, I think, an easier way to gain income rather than taking the credit lending rather than lending and then taking the credit cost into their P&Ls. So I think now with the prediction of the interest rates also moving up, and probably the gap between the G-SECs and AWPR, if it contracts with the expansion in the economy, the banks are ready to take on more credit, I think, into their books, and it will be then, since they are steady with their balance sheets, they'll be ready to grow the balance sheet and also give the government the impetus to grow the economy.
Okay.
I hope I have answered your questions.
Yes.
Is that okay, or did you expect anything more?
No, that's okay. Thank you, Rachini. I see some of the bankers in the room were chuckling when you made that comment. Dimantha, if I may ask you, you touched on the debt restructuring, but this is sort of to try to delve into that a little more. We may have to tighten our belt and constrain spending in order to meet these deadlines by the IMF. What action plan do you think the government should sort of approach or take to sort of build economic growth while also being mindful of the budgets that have been set before them? What are your thoughts on that?
Yeah, I think the traditional debt-led growth model doesn't seem to work or is not really sustainable. And also we don't really have fiscal space for that. So I think the best way forward right now is if you can stimulate growth through other means. I mean, how can you do that? Because factors of production are also not too attractive. But we do have other elements that we can look at. I mean, for a start, there was earlier a program of looking at privatizations, which could have been one element where you can attract FDIs. But if the government is not willing to go on that path, a better path would be to look at PPPs. I think public-private partnerships might be a better way forward, and that will sort of guarantee some of the safety nets that the government is also looking at. And also another approach there is once you have the PPPs going, you have the investments also coming in, so you can expand some of the sectors that have not really opened up. And another way forward is looking at other avenues of, so we have a lot of sectors that are already growing in the country. So supporting those sectors are also another area that we can look at. So tourism is a key area. I think IT is another area. So these areas have not really been given the adequate support to really market and grow. So for example, tourism, we've had this airport expansion project that was due for a long period of time, but it's still not really up and running. So the basic infrastructure to really grow these industries to the next level are still not there. So if we can fast track some of those core elements, are one of the ways forward to really take these growth rates up. Yeah.
So what you're saying is basically pick your battles, prioritize the expenditure. Makes sense. Gihan, if I may just ask you, I mean, we're coming to this because it is a topic of importance and it's a big project. The West Container Terminal, right, which has been, it's been on the talks for a long time and, you know, in the news. But how is the progress on that? And moreover, with the East Container Terminal also sort of expected to come online soon and handle about 2.4 million TEUs, how is JKH sort of going to manage that, and how do you envisage being able to handle the capacity?
Yeah, in terms of the project itself, we are just about to commence phase 1. So we've made very good progress on construction, and I think if you look back, we started this project in the height of the financial crisis, so Credit to the teams in terms of getting things off the ground and actually completing things. So we are just about to commence operations. So by the end of next month, we'll be in a position to start operations and then ramp up. So phase 1 will bring in about 1.6 million TEU into operation in a sort of phased or ramped manner. And the rest of the 1.6, so it's a total of 3.2 million TEU, will come in maybe within the next sort of 18 months or so. In terms of Colombo and deep water capacity, as you all know, the port of Colombo right now is operating at pretty much capacity. We have only one deep water terminal, which is pretty much full, and 2 other terminals that feed off essentially the deep water capacity that's brought in to Colombo. So the expansion of capacity actually into Colombo is long overdue. It's at least a couple of years overdue. And we've actually lost out in terms of an opportunity for Sri Lanka and the port of Colombo as a whole, because we could have capitalized and actually grown volumes in Colombo a lot more had we had that capacity. But having said that, it's better late than never, and we are going to have that capacity in a month or 2. And that will really help drive more demand, because you need to have deep water capacity to bring in the vessels that will drive ultimately transshipment volume. Today we are seeing around 85% of volume into Colombo is actually just transshipment, and most of that is in and out of India. So long term, if you look at it, growth is driven by containerization in India, the trade volume growth in India, and ultimately that's really where Sri Lanka will benefit from. So if you look at it on a more sustained basis, that will continue, because as long as India grows and containerization in India is there, there will be demand for Colombo. Colombo has a sustained advantage with our geographical location. So yes, India is developing port capacity, but in the end, still Sri Lanka is placed such that you still are closer to the main shipping lines, the routes, and it's less of a deviation to Colombo than it is to Indian ports. The other aspect is that unless cargo is destined or bound for one coast of India, either the east or west coast, you're looking at then a ship dropping off boxes on one coast, and then those boxes having to essentially sail past and below Colombo to the other coast. So it's far more effective for you to drop off boxes in Colombo and then have that get split to the east and west coasts of India. If you look at the order books of the large shipping lines, you'll see that they've gone for the larger generation vessels, and that sort of obviously indicates that they are believing and investing on the basis of the hub and spoke model continuing, and obviously Colombo has a benefit of being a transshipment hub. So when you look at those type of investments, you're investing in ships, and those investments are for 20, 30 years, so which gives Colombo the ability to have sustained advantage. So the fact that even with the East Container Terminal coming on stream, I think the studies that we've done, and we've got a couple of studies that have been done, which will show that overall Colombo will need this volume. If you look at Singapore, Hong Kong, Malaysia, I mean, Colombo today has about 8 million TEU of capacity. With both the East and West Terminal coming on stream, that will increase to about maybe 15 million TEU. But still, in terms of the opportunity, I think it's far greater than that. So overall, I think whilst in the short term, you'll have maybe some supply coming in and demand may not immediately increase overnight. But I think with the crisis that's going on in the Middle East as well, there is, I don't want to use the word opportunity in that sense, but Sri Lanka can really capitalize on the demand that's there right now. The last point I'd like to make is on the East Container Terminal. I don't know how soon that capacity is also going to come on stream. It's been a long time in the making. I mean, the West Container Terminal we started just over 2 years ago, and we're now ready to start operations. So it's long overdue, but I don't think that 3 million TEU of East Container Terminal is going to come in the next sort of 6 to 12 months. But that's not for me to really directly comment on. But I think still Colombo needs that capacity.
Okay. Thank you, Gihan. That was good input. Rachini, just to sort of touch base with you, there was a recent amendment to the Banking Act, June 2024, if I'm not mistaken. And I know there have been lots of data on it, but I think this is a good forum for us all here to kind of zoom in on what you feel might be the key things that might impact an investor or a company looking at different things, the banking sector, from those amendments. So what are the key things, the key takeaways that you would sort of highlight from that?
So the Banking Act, new Banking Act came into effect this year. And for me, there are three key areas. One is on the lending, the credit concentration. Second one is on the related party lending. And third one is on bank ownership and the board governance structures. So if I hone in on the first one, that is lending to the or the credit concentration, this will come into effect from 1st January 2026. Earlier on, the large companies' exposure, single borrower exposure was 15% of the total capital. That is Tier 1 and Tier 2 both put together. But from 2026 onwards, the single borrower exposure is being brought down to 10% of the Tier 1 capital, which means Tier 1 is basically the shareholder funds. So some of the banks might have to shed some of the exposures to the large companies. Then secondly, on the related party exposure front, right now it is effective from 1st January 2025. Earlier on, there were less stringent measures in lending to related parties. But from now onwards, I think when you're lending, you have to get better accommodation, or that is better security from the related parties. So both those together has brought in more risk management measures to the banking sector. And on the ownership front, the material interest of a single shareholder has been capped at 10%. So there are, I think, shareholders who have more than 10%. That probably it's not very clear at the moment, but the central bank may take measures in gradually phasing out the excess exposures being held by a single shareholder. But there is no proper direction given on that, but new shareholders can only go up to 10%. And so therefore, that might impact even the capital raising of banks, and especially when they have to bring down large exposures to a level of 10% of the Tier 1, you have to expand your capital base. And to expand the capital base, of course, you need more capital being raised from the shareholders. And if each shareholder's contribution is restricted to 10%, some banks which have shareholders who are having more than 10% might have to bring in new shareholders or reduce their exposures. Then also on the governance front, a lot of measures have been brought in, especially on the risk management and independent directors, especially from 2027 end onwards. I think all banks will have to have independent chairpersons. So therefore, the shareholders who have nominated their directors or as chairpersons will have to relinquish their positions and bring in independent directors. So all these are, I think, especially directed towards better risk management in the banking sector for the safety of the depositors and other shareholders.
Thank you, Rachini. Definitely a necessary evil and lots of preparation needed for banks, I think, in line with that. Hasita, if I may ask you, US has just got a new president and lots of changes there. How do you all see this impacting our global export dynamics with apparels and all of that? Do you see major changes?
Yeah, so first of all, I think next week we'll see the new president coming in, but the biggest question is whether what he spoke about in the platforms before the pre-election, whether they'll be actually be implemented or not, because the bigger one will be the tariffs, because tariffs, I think, is a big question mark. I think in some of the platforms he was talking about 60% tariff on China and some selected economies like Mexico, etc., also to go through significant increases in the tariff rates. And then in general for other countries, all including probably Sri Lanka in that bucket, if you count in that, to have 10%. So these were spoken in many platforms, but whether they'll be actually implemented or not, we'll have to wait and see. 60% for China, I think I'll be very surprised if that's been done, but having said that, that's what Trump is all about, right? Surprise. So we'll have to be ready. So we can't rule out any scenarios that can emerge out of this. So over the last few years, the global apparel brands have been working very closely on some of these parameters, because 10 years ago when Trump came, or 8 or 9 years ago when he came, in preparation of that round of his tenure, there were a lot of work done to de-risk some of the overexposures in places like China. So that has been happening for about over 10, 12 years now. Most of you know that apparel brands and some of the other exporters to US have been de-risking the manufacturing in China and relocating a lot to places like Vietnam and Bangladesh. So that will continue, and that will continue, and that probably will help us, and that has been helping countries like Sri Lanka over the last few years. And what we see is that that will continue to help us. But having said that, the 10% type of tariff to be brought in, I have my doubts whether that will be also done, because that will create inflation in US to a large extent as well, because you can't pass on everything to the supply chain, so there has to be some level of price adjustment there. And if the prices go up in the US markets, that again leads to inflation. Whole interest rate story that we are talking about can be questionable. And China has already come and said that if you do this, we are going to devalue the currency. Right? And if China devalues the currency, rest of the world will also have to do something about it, including ourselves. So that will create a lot of chaos, a lot of scenarios can emerge. But I think the summary of it is that manufacturing in China will get go into de-risking, and some of the other countries as well. And a lot of the transshipments happening through places like Mexico will also get adjusted, because that's another big topic. Most of you know that a lot of apparel brands, including Amazon and some of the other online brands, get their stuff into US and then get them stuff into peripheral countries like Canada, Mexico, etc., have their big warehouses there, and then they ship to US. As long as it's a parcel below $800, it's duty-free to US. So they get out of this duty by just using the peripheral countries to have the warehousing going. So that's an area which will probably get seriously targeted in this tariff structure. But that again, there are a lot of lobbying that is happening, because the biggest beneficiary out of some of these things is people like FedEx, UPS, who also have a big influence in the US policy making, right? So these are things to be seen whether it actually can be done or not. But we are seeing at the moment is that China relocation and some of the other aspects will definitely help countries like Sri Lanka. But we will also continue to, we have to continue to look at investing into technology and productivity improvements, like I said before, because what happens with China being pushed, they keep innovating more and more. Right? In the last 3 to 4 years, the amount of innovation that has happened, automation that has happened, both from product and manufacturing perspective in China is amazing. Right? It's amazing. They've just taken it to the next level, and with more than $1,000 per person, whereas ours probably will be at about $250, $300 level, almost 3 to 4 times labor cost being higher, more duty being applicable as of now. Still, they are competing with better pricing compared to countries like ourselves, India, etc. Right? Why? Because their productivity is so high, their automation is so high, and the use of digital and other technologies have been remarkable. So we have a lot to learn. And I think the takeaway for me is that, and for us is that as industry, as Brandix, is that how do we quickly learn what's happening in China and replicate it here as fast as possible so that our productivity can be taken up. And for that, we need to go for more collaborations and more partnerships with the Chinese. And we have a good, conducive environment with Chinese people working here. Communities are happy to work here, so that should be encouraged. And we should go for more partnerships and see how we can create more productivity improvements in Sri Lanka so that we can take advantage out of this environment and probably look at more growth.
Thank you, Hasta. I think now is a good time for us to break into Q&A. I'm sure you all have heard the valuable opinions of the panelists on stage and possibly have a few more questions. So I believe there are mics going around. Yeah. The floor is open. A reminder to those watching us on socials also to please post in your questions to us on the chat box on Zoom. I believe the questions have been already answered, I feel. Who's going to be the first one? Okay, we have one there. If a mic could please be sent. The first one always needs the most courage. Everybody else follows through after that.
Thank you. This is Sanat Nanakar from the Island newspaper. I'm a guy from the media.
Sorry, we can't hear you too well.
Sanat from the Island newspaper. Can you hear me now?
Yes, if you could stand, that might be better.
Right. Okay. Is a good year for investment banking and the capital markets. Would always be a good year for the general public. Thank you.
Dimantha, maybe you might take that. You want him to repeat it?
Yeah, sure. So, if you look at it as we expected now, in terms of the economy, now we are in a revival stage, and what we did not see in 2024 is some of the business activity or funds getting transferred to the, let's say, the lower middle income and the lower segments in terms of businesses, maybe the MSME segments. So that was a concern. And though the GDP growth levels were coming in, the trickling down effect was not fast enough. So now what we've seen is with the, that was one of the major reasons for the rate cut in November, and following up towards the final quarter of last year, we are starting to see that revival now happening and the trickling down effect gradually moving in. So if you, when you talk to some of the smaller banks or even the MSME segments, you can see the recoveries in the MSME segments starting to improve and becoming better. So the cycle has started to move down to that segments as well. So with that, that's why we are expecting during the first half of the year for the consumer demand to be quite big. So with that, you will see the business activity significantly improving. Yes, that will have some pressure on interest rates as well, but we do have capacity to take in that pressure. The economy has capacity. So because of that, yes, it's going to be a better year, and probably most of the community might start to feel that growth is actually starting to happen.
I hope that answered your question. Okay. Anyone else? Who's the next one? In the meantime, we have a question that has come in on online. Dimantha, that too is for you. So I'll just read it out. You have given a target of 17,000 to 17,500 for the ASPI at the end of 2025. As of now, we have passed 16,300, which is relatively close to your target. If the earnings come down year on year, either the price to earnings has to re-rate or the market has to come down. What is your opinion on this?
Yeah, so what we are expecting is earnings to grow by around 22% this year. We've actually upgraded from 15%. So with that, what is so basically it's faster than what we earlier anticipated. So growth is going to be better. So with that, now why it's 17,000 and not higher as some of the others anticipate is if you take the earnings of last year, there is a lot of one-offs there. So you need to take that out when you're when you're looking at the valuation. So what we've done is we've taken that portion out and applied growths after that. So when you do that, your valuation comes much lower, and that's why it's the 17,000 target. So yes, it's if the rates start to be around this, yes, alternative investments such as equity will perform better, obviously, because finance cost is lower, investments are high, so corporate earnings will be better. But something that also you need to be mindful is that beyond a certain level, you need to really start making profits as well. So as long as the markets move in line with expectations or gradually, I think there's a lot of room for returns to be made.
Thank you, Dimantha. Gihan, the next one is for you. What do you think Sri Lanka needs to do in terms of offerings, etc., to raise the level of tourist spend to compare with the likes of Maldives, etc., where spending could be approximately $500 a day?
Yeah, I think people talk of sort of us being the Maldives, and I think we have a diverse array. So I don't think it's necessarily, whilst we will, of course, get our ARRs up, we have a diverse offering, not just in terms of the type of attractions, but also in terms of the types of product that we have. So there's a certain segment that we've really seen that's grown, the high-end boutique hotels. So if you look at our own Cinnamon Air that caters to a lot of these hotels, we've seen them really scale up, and that segment has really recovered. So to drive that, yes, you need other products coming in. You need to increase that sort of the connectivity, even the airport, how people come in. So that aspect needs to be addressed. But similarly, I spoke of City of Dreams, Cinnamon Life. So there's a certain segment that you will get in coming to Colombo based on those type of attractions, bringing in the conferencing, a different type of segment. But I think Sri Lanka is not only about saying, okay, we have to get to where the Maldives is, because it's a different destination. And given the diversity of the offering, I think it's a question of, yes, upscaling and moving people up that ladder, but also having the different segments that will ensure that all different types of people who are involved in the industry also will benefit from that. The other aspect is if you look at, say, even Colombo, today we've got, say, maybe 5,000 star class, 4-5-star class rooms. Colombo on average might be running at about 50% occupancy, and you look at it saying there's overcapacity. But it doesn't take a whole lot to move the needle in terms of absorbing that capacity. So if you're looking at a couple of 100,000 tourists coming and some of them coming into Colombo, that capacity gets absorbed fairly quickly. And that in itself lends to rates going up. And I think that's what we can see. With 2.5, 3 million tourists anyway, you'll see the ability to take our rates up because we've always been sort of having this issue of not overcapacity but less demand. So I think that price competition that's been there will dissipate.
Thanks, Gihan. Any question? We have a question here.
I don't know if this
We have a mic issue.
Hi. So, listening to you guys, I felt very optimistic. I can see clearly now the rain is gone. I can see all the obstacles in my way. It's a bright, sunshiny day, which I think is a good view to have. But I also wanted to ask, as you look in the medium term, say in the next 5 years, and maybe you can answer from your different perspectives, what are the obstacles that you see in your way? What are the main risks that we as a country need to recognize and avoid and preempt to have a kind of a sober view of the fact that, well, we can't forget that we've come out of an economic crisis and we must avoid another one. What would you, how from a business perspective, from a maybe macro perspective or a regulatory perspective, how are you looking at what needs to be done to keep the obstacles at bay?
Who'd like to take a stab at it first? It doesn't have to be one. It can be a compilation of views.
Okay. Shall I take it up? Yeah. So, on the government side, I would say there's a lot needs to be done. Yes, we've sort of brought down the budget deficits and so on. But if you look at similar countries such as Sri Lanka, still our budget deficits are pretty high. Our revenue levels are pretty low. So there's a lot of leakages, and digitalization on the government side is very, very low. And so on that side, there's a lot that can be done, closing out on the leakages, probably digitalizing some of the areas. Government can lead the front where you have a sort of a cashless society. So that will, these are some of the things that other countries have done when they are coming out of the crisis, like Rwanda, Argentina, things like mainly in the transportation segment, going cashless. So these are things that they've done. So I think we've not really gone to that extent as yet. So on that front, a lot can be done, and we need to really bring down the budget deficits. And also on the other side, on the SOE restructuring, yes, now we are cash surplus some of the main entities, but is that enough? Because we've just really raised the prices, and that actually impacts a lot of businesses. So we do need to do the restructuring, get the prices down, because otherwise investments are not going to come. Our factors of production, we are competing with countries like India, Bangladesh, Vietnam, where, which looks like to be more attractive than coming into Sri Lanka. So we need to really up our game, make ourselves more attractive. So restructuring needs to happen soon and fast to go forward. Yeah, that's my 2 cents.
I just said on export side, I think one of the key things what we would look at is also the consistency in the exchange rate, because that's something that we had seen a 200 going to a 365 and then suddenly coming back to 290. And that kind of volatility really kills the whole momentum, because as an exporter, if you look at very selfishly short term, you will say depreciation is good, but it's not necessarily, right? Because we saw it move into 365 within a very short period of time, and then all the buyers still run and say that, hey, your exchange rate came down, now you can give some back to us in the price adjustment. So after you do that price adjustment, suddenly it has come 20% into appreciation. You can't go back and ask for price increases. They'll say, oops, we'll talk about it later, right? So larger portion of that depreciation actually went with the, as I said, demand dropped at the time in the apparel industry. and in some of the other export industries as well, and that pass-on effect to the, basically to the customers happen. So you really lose the battle. So what we should look at is probably better consistency. I think your prediction, I think, is fairly consistent with, if you talk to 10 bankers, maybe 8, 9 will tell the same thing, right? And that's the type of range, 5% year-on-year type of depreciation. But sometimes some people talk about 245, 250 also, right? So that's a bit shocking. So that's what we should not have. We should have consistency as much as possible as exporter. While in a short run, in a selfish way, you might say you like depreciation, but it's not. It's actually what we're looking at is more consistency. And I'm sure even an importer looks at the same thing.
I think if I may add, apart from the obvious things like, we are certainly not out of the woods, right? There's a really good platform, and as long as we stay the course, maintain that discipline. So there are the obvious things in terms of government policy, continuation of the independence of the central bank, some of the things that have been done. And as long as we continue doing what we have been doing, I think that part of it is less of a concern. I think in terms of some of the other risks, I think Hasita touched on it to some extent in terms of talking about productivity. I think our technology investments, for me, one of the biggest other things that we really need to focus on is talent in the country. So we've seen a lot of an exodus of people leaving the country, but even with the people that we have, I think we have to really ensure that we upskill. So it's linked to even the productivity, the technology enablement, not just in terms of investing in, say, plant and machinery and manufacturing capability, but also the enablement that you do with people. So if I just talk about our own experience, say, at John Keells, we invested a lot over the last 3-4 years in terms of trying to look at more data-driven decision-making, analytical transformation, using the type of data that we have. And today we have about 60-65 data scientists and data engineers in the group working on different use cases that really, it's not to take the human or people out of the equation, but how do you supplement the type of decisions that we make with giving those type of insights through the power of technology as well. So I think that's an area that we as a country have to really invest and grow. Growing our people, and then connected with what Hasita said in terms of the technology enablement as well as productivity, which I think will really pave the way for more sustainable growth.
Thank you. So we have a question there. Okay. Can a mic be sent across? Sorry, Rachini, you had some comments.
No, that's fine. So actually, I was thinking now that the interest rates are at a low level, especially the people who are dependent on interest income might be enticed to take on risk, not investing probably in the regulated sector, but in the unregulated sector, cryptocurrency and so on. And so therefore, we have to avoid a crisis of that nature at all times. And also, now, the regulator also has brought in business revival units for the bank. It has been just renamed today, I think, or yesterday. So I think business revival is good, but at the same time, we should avoid another crisis coming from impairment and post-COVID kind of issue in the private sector. Thirdly, I think also sorry, now I forgot what I was trying to say. The third issue is also, let me...
That's okay. Shall we come back?
Yeah,
no problem.
Yeah.
Yes.
Yeah, that
Sure, go ahead.
question is from Rachini again about the banking sector. Every year you see the banks growing their bottom line 20% to 25%. This time also there's a good story on the whole banking sector. If you look at, if you analyze the profitability, is it because to the reversal of the provisions, or is it something else that has triggered the overall growth? That's the question. In terms of for the organizers, those presentations are really nice, and like to know whether you are basically sharing those with the participants, because it will be very helpful if you can do that. And back to the bank, I think there was a comment saying the SME sector, all these big organizations growing, would it actually trickle down to the masses at the end? So has the growth of the banks in those percentages, has it really benefited the masses? So those are the questions. Thanks.
Sorry, regarding the profitability of the banks, each year has been different scenarios. Well, if you take 22, 23, the high interest rate regime, I think, helped the banks to record good profits despite high impairments. But 2024, I think most of the growth would come from the reversal of impairment. But to answer the rest, can I ask Dimantha to take on from there?
Yeah, so if you take 2025, I think now we've had lower spreads. So what we are looking at for 2025 is mostly to come from growth. Basically, lending growth coming in. So we are also looking at a slight increase in interest rates. Probably the spreads may gradually increase as well. And also, since the ADR is complete, some of the banks' capital adequacy ratios where it was low would improve, so giving them more capacity to lend as well. So also the economy reviving also gives opportunity for growth. So I think that's the area that profitability will come out in that segment.
I think we had one question. We have time for one last question.
Right. So I had two questions. Let me ask
Sure.
both. The first question is related to something that both Hasita mentioned and Ihan mentioned. As Dimantha pointed out, I think there are certain institutions who kind of got the currency calls right over the last 12 to 18 months. But even if you take a step back about 12 months ago, it was fairly shocking to see the kind of currency predictions which were coming through. So, I mean, related to the point that exporters face in terms of the consistency of the currency forecast, do you think that the bank FX traders who are very good at predicting the almost like momentum-based currency movements, but they actually got the 6 to 12 months kind of currency forecast incorrect? Because if you look at even the East Asian crisis, currency shot up during the crisis, but in the normalization, it actually came down. So, I mean, people who took a mid to long term, more of a fundamental approach to forecasting the currency got it incorrect. And actually, in a sense, what the challenge the exporters and importers face is inability of FX traders to get their currency call right. That's my first question, and after that, I'll move on to the next question.
It's more about economic side.
Yeah, so I think it's sometimes difficult in a crisis to also forecast the currency. So partly it's due, I think in the last 2 years, partly it's due to the crisis where you had an overshot probably in 2022 and the correction probably coming in 2023 and 4. But I think towards the latter half of 2024, it was more to do with the delay in the demand picking up in the system. I think we've expected a gradual pickup somewhat starting from the first half of the year, then it really did not happen there. Then towards the second half also, the demand coming in from the system was pretty low. And also on the central bank side, they've somewhat tried to maintain some level of consistency. But on the other side, you could also say that there was a significant peak in the tourism segment as well. So I think that has been the problem here in terms of last year, where the delay in the demand picking up, and the government also not sure when to really push demand to come in, because we are also really coming out of a crisis. You can't really push too much. So I think now is a perfect time where you have some level of reserves grown, some level of stability, and we can handle the demand even at an accelerated pace that may come in. So probably 2025 is the year where you may see a more normalized FX movement with a reasonable level of growth coming in.
Could we just get that? Yeah.
Last question is on the banking sector. I want to ask Rachini this question. Now, with restrictions coming on, restriction tightening on the single exposure limit, would large banks who have traditionally had a larger share of the larger corporates' loan books have to give up some of the share? Does that mean that smaller banks will become more competitive in terms of lending to larger corporates? But as a reaction to that, would larger banks become very competitive in domains where smaller banks are focused on? So from a competitive landscape perspective, how do you see this impact of the regulatory changes?
So you're right. I think the share from the larger banks will go to the smaller banks, but also the smaller banks will also have a capacity limitation based on their tier 1 capital, right? So therefore, yes, there will be diversification, but at the same time, I feel very large corporates might have to go to the market to raise capital. And that will reduce the dependency on banks for capital. And it will help the capital markets to grow, I believe. That's my take on it, actually.
Thank you very much to our esteemed panel this evening. I, for one, am leaving that much wiser, and I'm sure you all are too. Thank you all for being such an engaging audience as well, and we hope that you continue to enjoy the evening. There are drinks, there's dinner. You can pick there are bankers here, there are from different sectors, and have great conversation, and we shall continue this on that side. The panel, thank you so much for your time amidst busy schedules, and I think there's a picture that they want to take with all of you, so we'll quickly move on to that. Yeah. Thank you so much.
Thank you very much. We really appreciate that. Please remain on stage. We would like to invite Dilshan Veerasekara, Managing Director, CEO of First Capital Holdings PLC, to present tokens of appreciation to Gihan Kure, Hasida Premaratna, and Rachini Rajapaksha. We would also like to say a very big thank you to our keynote speaker, Professor Anil Jayanta Fernando, Minister of Labour and Deputy Minister of Economic Development, our panelists, moderators, speakers, and everyone who made today a reality. Thank you very much for your valuable time. Once again, thank you very much. We really appreciate it. A very big thank you to our panelists, our moderator, and all the dignitaries, and every single person who made today a reality. Invest with impact and invest with purpose, and always keep flying high. Ladies and gentlemen, we warm welcome all of you to join us for cocktails and have a pleasant evening.